Welcome to the Deep Dive, where we cut through the noise and get straight to the crucial insights you need. Today, we're taking a deep dive into the, surprisingly fascinating world of auditing. Specifically, we're focusing on a really important distinction: audit procedures versus audit evidence. We've pulled insights from a source called examiningevidence.pdf, and it does a fantastic job breaking down how auditors think, and more importantly, how they actually gather the information to, verify financial statements. Our mission today is simple: give you a shortcut to understanding a really crucial aspect of business and finance. Because here's the thing, even if you're not an auditor, understanding how financial information gets verified, that's incredibly powerful. It's about knowing what concrete proof exists behind those big numbers you see in reports. And frankly, behind almost any claim you encounter. It gives you a built-in, let's call it a reality checker in the best possible way. So, to really grasp this, let's start with the basics. What is the fundamental difference between an audit procedure and audit evidence? Think of audit procedures as the actions auditors perform.
These are the doing words, right?
It's like inspecting, counting, attending. They're the audit tests or, the actual audit work being carried out.
That's it, the verbs.
Then audit evidence, on the other hand, that's what the auditor obtains. It's the direct result of doing those procedures. It's the tangible proof, the document, the observation, the confirmation.
Yeah, and it's fascinating how crucial this distinction actually is. In the world of auditing, if you confuse the two, you've completely missed the point of the question being asked.
Wow, okay.
It's not just semantics. It's like fundamental to the whole verification process. If you ask for evidence and someone describes a procedure, it's like asking for a photo of the suspect and just getting told how the police tried to take the photo. It doesn't answer the question.
That's a perfect way to put it. It really highlights how precise you need to be. The source we looked at gives a great example. Performing a circularization of receivables debtors. That's a procedure.
Right.
Now, for anyone thinking, what on earth is that?
Yeah.
It's just the technical term, really. It just means auditors directly contact a sample of a company's customers.
To confirm how much money those customers owe the company, right?
Exactly. So performing the circularization, that's the action, the procedure. But the replies from customers that come back confirming the balances, that's the evidence obtained from the action.
Okay, that makes it much clearer. Action versus result.
Precisely. And we can look at more examples from the sources list, which are quite helpful. For instance, inspecting non-current fixed assets for signs of obsolescence. Checking buildings or machinery for wear and tear. That's an action.
Right.
Or counting petty cash. Attending a wages payout. Again, all clearly procedures. Actions taken. You see those strong verbs.
Gotcha.
But then you have things like a bank statement.
Okay, that's a thing. Evidence.
Yes. Or a working paper showing a recalculation of depreciation, or a sales invoice. These are all pieces of evidence. They're the results or the documents obtained. And, the phrasing matters a lot, especially when you expect to find that evidence in the working papers.
Working papers. Remind us what those are again.
Think of working papers as the auditor's detailed case file. Everything's in there. Every document, every calculation, notes from conversations. Basically, everything that supports their final opinion on the financial statements.
Right, the audit trail.
Exactly.
Right.
So just saying a sales invoice might not cut it for a working paper. Often the preference is for something like a copy sales invoice or a copy bank statement with the balance cross-referenced to the bank reconciliation. It shows it's part of the documented audit work.
More specific.
Much more specific. Even something that seems straightforward, like an item of inventory stock that is present at the inventory stock count. That's an observation, sure, but how do you document it? For the working papers, you'd really expect to see something like a schedule showing items test counted at the inventory stock count.
So the schedule is the evidence in the file.
Yes, because the schedule documents what was done, the procedure of counting, and what was found, the result, the evidence. That's the level of detail needed.
Okay, this precision makes sense.
Yeah.
But it also brings up a big question. How do auditors even know where to start? How do they figure out what specific evidence they need to look for? Especially when you get into complex areas like those substantive testing questions.
Yeah, it could seem totally overwhelming.
Right.
But auditors have a powerful tool, a framework, really. Financial statement assertions.
Assertions?
Yeah. Think of them as the silent promises management makes about the numbers in their reports. When directors sign off saying the financial statements give a true and fair view, they're implicitly asserting certain things about those numbers.
Like what kind of things?
Well, for example, completeness. That's an assertion, meaning all the assets, liabilities, transactions, events that should be in the financials are actually included.
Nothing is missing.
Exactly. No hidden debts, no unrecorded sales. Another big one is valuation.
Making sure the numbers are right.
Yeah. Essentially, yes, that assets and liabilities are included at their correct, appropriate carrying value. Not overstated, not understated. Auditors design their whole audit program, all their procedures, to gather evidence about these assertions. They want to ensure, as far as possible, that each assertion holds true. And by doing that, they build the case, the evidence, that the overall financial statements are true and fair.
Okay, so these assertions act like a checklist or a roadmap.
Pretty much. A roadmap is a good way to think about it. It turns this huge, potentially confusing task into a systematic process.
So instead of just vaguely asking, are the numbers right? They're asking specific questions tied to these assertions.
Exactly. Is it complete? Does it actually exist? Is it valued correctly? Does the company truly have the rights to this asset or obligation for this liability?
That sounds much more manageable and systematic.
It is. It gives them a sensible way to approach things. Even if the specific industry or transaction is unfamiliar, they can always break it down by assertions.
It really shows the methodical nature of it. And, these principles can seem a bit abstract, but they really come alive when you see them in action. Let's dig into a scenario from our source material, the audit of a company called Yummy Mummy Co.
Okay.
Let's put ourselves in the auditor's shoes. Yummy Mummy Co. is a listed company. It's a European chain of fashion stores for babies and expectant mothers. The audit is for the year ended September 30th, 2006. It's nearly done, but there's been a significant drop in profit before tax. That's a red flag.
Definitely.
So for this deep dive, let's focus just on what audit evidence we'd expect to find in those working papers. What convinces the auditor? First up, scenario A. Italian stores impairment. The issue is falling birth rates in Italy mean the stores there are doing worse than expected. This triggered an impairment review, basically, checking if the value of those stores on the company's books is still justified.
Right. Are they worth what the balance sheet says they're worth?
And the review found that the recoverable amount, the most they expect to get back from those stores through use or sale, was $23 million lower than the carrying value on the balance sheet. That's a big hit.
Okay. So a $23 million impairment loss. The auditor needs solid evidence for that. First, you'd absolutely expect to see extracts from the management account.
The internal numbers.
Exactly, showing the Italian store's actual performance sales, profits compared to their budget. This confirms the worse than expected part. You'd also want to see their latest budget, say for 2007, to understand their future projections for Italy.
What else?
Crucially, a copy of the board minutes.
The official meeting records. Why are they so important here?
Because they should detail management's plans. What are they going to do about these underperforming stores? Try to turn them around, sell them. This is vital. If performance keeps tanking, it might raise going concern questions. Can the company keep operating? Or, if they plan to sell, the stores might need reclassifying as assets held for sale, which has specific accounting rules. We'd also need to see the company's impairment calculation itself, a schedule comparing the carrying value of the assets with that $23 million lower recoverable amount. And the schedule should be annotated, showing it agrees to the asset register, and that any allocation of central costs or goodwill seems reasonable.
So checking their math and logic.
Precisely. And part of that recoverable amount is often based on value in use, the future cash flows the stores are expected to generate. We'd need to see that value in use calculation annotated again, comparing the projected cash flows against past results and future budgets to see if management's assumptions are reasonable. That justifies the $23 million figure.
Wow, okay. That's a lot of interconnected evidence just for one issue.
It is. Auditors need to build a strong case.
Let's move to the next challenge Yummy Mummy faced. Scenario B, the Manchester factory closure and a related redundancy provision. So the company used to make its own goods, but research showed it'd be cheaper to outsource to Southeast Asia.
A common story.
Indeed. So they decided to close their Manchester factory, and they've put aside $3.2 million in the draft, accounts for redundancy costs. That's the provision.
Right. Money set aside for expected future costs. Here, the auditor's main job is to verify if that $3.2 million provision is legitimate and accurate. First things first. We need a copy of the official announcement of the restructuring, the factory closure.
Why the announcement?
Timing is critical in accounting for provisions. For a provision to be validly made in the 2006 accounts, the company must have formally committed to the restructuring before the year ends September 30th. The announcement usually provides that evidence.
Okay, so the date matters hugely.
Absolutely. Then we need a working paper digging into the basis for those redundancy payments. Are they contractual based on employment contracts? Are they statutory required by law? Or are they constructive obligations?
What's a constructive obligation again?
That's where the company, through its actions or statements, creates a valid expectation among employees that redundancies will be paid, even if it's not strictly in the contract or law. The working paper needs to explain how that obligation arose, if it's relevant.
Got it.
Then you need the detail, a schedule listing every redundant employee and the calculated payout for each. And that schedule needs annotations showing, 1, that all the relevant employees are actually on the list, and 2, that for a sample of employees, the calculations were checked, agreeing pay rates, length of service back to their contracts, and so on.
Verifying the calculation accuracy.
Exactly. We'd also look for points in the management representation letter.
That formal letter from management.
Yes. We'd expect management to confirm if there are any other costs related to the closure that need providing for maybe penalties for breaking leases on factory equipment. And another point in that letter should state whether the factory building itself is going to be sold or just abandoned.
Why does that matter?
Because it affects how the factory assets are valued on the balance sheet. If it's up for sale, it's assets held for sale with specific valuation rules. If abandoned, it might just be written off. Different accounting.
Okay.
And finally, related to the reason for the closure, the outsourcing, we'd want to see evidence like a copy of the invitation to tender for the outsourcing contract, and maybe notes of discussions with management about how they selected the manufacturer in Southeast Asia and what quality controls are in place. It provides context.
Right, connecting all the dots. Okay, final scenario from Yummy Mummy Co. Scenario C, property sale and leaseback. To get cash for that Southeast Asia expansion, they sold properties for $200 million right near the year end, September 28th, and then they immediately leased those same properties back under what they're calling operating leases.
Sale and leaseback. This is a classic area auditors scrutinize closely. The absolute key focus here is it really an operating lease, which is basically like a simple rental agreement? Or is it effectively a finance lease, which is economically much closer to the company still owning the asset and having a loan? The accounting is completely different.
So they need proof it's just a rental.
Or proof that it isn't, despite what management calls it. So evidence number 1, a copy of the actual leasing contract. The details are in the fine print. Then, a schedule comparing the present value of the minimum lease payments, essentially, the total cost of the lease discounted to today's money with the fair value or market value of the properties.
Why that comparison?
If the present value of the payments covers substantially all of the property's fair value, it strongly suggests it's a finance lease, not just a rental. The company is effectively paying for the asset over the lease term.
Okay, that makes sense.
We'd also look for a note comparing the length of the lease term with the estimated useful economic life of the properties. If the lease is for, say, 90% of the property's useful life, again, that leans towards a finance lease. And that note should also clarify who's responsible for maintenance and insurance. If it's Yummy Mummy Co., that's another indicator they effectively retain the risks and rewards of ownership, like in a finance lease.
So lots of indicators to weigh up.
Definitely. And crucially, the auditors might prepare their own schedule, calculating the amounts that should appear in the financial statements if they conclude it actually is a finance lease. This shows the potential impact of disagreeing with management's classification.
A what-if calculation.
Exactly. Also, if it is deemed an operating lease, we need an estimate of the property's carrying value at the date of sale. Why? Because if the $200 million selling price wasn't actually the fair market value, it affects how much profit on the sale can be recognized immediately.
Accounting rules getting specific again.
Always. And one last thing. Another point in that management representation letter. It should confirm who the purchaser of the properties was. We need to know if they are a related party to Yummy Mummy Co., like a subsidiary, or a company controlled by a director.
What does that matter?
Because transactions with related parties need special disclosure in the financial statements for transparency. If it was a related party, we'd expect to see a draft of those disclosures.
Okay. We've seen just incredible detail across these 3 scenarios. Auditors really are like financial detectives. Let's just zoom out for a second. We've seen what evidence they look for. Pulling it all together, what's the overarching why? What's the fundamental purpose behind gathering all this specific stuff?
Well, the source material highlights, I think, 3 key reasons, which we saw playing out in the Yummy Mummy examples. First, Evidence to show that the company's accountant has calculated the figures correctly.
Checking the math.
Checking the math, yes, and the assumptions behind it. Like checking the redundancy payment calculations or the value in use calculation for the Italian stores. Second, evidence to prove other relevant facts surrounding the numbers.
The story behind the numbers.
Kind of, yeah. Verifying things like the actual performance decline in Italy, or the details of the outsourcing plan, or the specific terms in that lease agreement. It contextualizes the figures. And third, evidence to prove that accounting standards and legal disclosure requirements have actually been complied with.
Following the rules.
Exactly. Things like checking the date of the redundancy announcement, comparing lease payments to fair value as the standards require, ensuring related parties are identified for disclosure. So it's about calculation, accuracy, factual verification, and compliance.
That really clarifies the different angles auditors need to cover.
Yeah, and it raises, I think, an important point for you, the listener. You can hopefully see now this really detailed, methodical process, how auditors build a case, piece by piece, to verify financial truth. It goes way beyond just looking at the final numbers. It's about digging into the underlying actions, documents, and compliance. It's a proper forensic exercise in proving claims.
Thank you for joining us on this deep dive into the nuts and bolts of audit evidence. It's been genuinely illuminating.
My pleasure. And maybe a final thought. This deep dive into audit evidence, it's not just about financial statements, is it? It really underscores a fundamental principle that applies to so much more in life. For pretty much any claim or piece of information you encounter, could be a news report, a political statement, something online, even just office gossip. The real powerful question to ask is, what's the concrete evidence behind it? What actions were actually taken? What verifiable results, documents, or proof exists? It's just a really powerful lens, I think, for critically assessing information in pretty much any field. What's the evidence?